Despite difficult market conditions, we're hopeful for a bounce back in direct investment into emerging markets. Our partners at Oxford Economics are tracking 2 quarters of capital inflows back to emerging markets, which, as long as they sustain for another quarter, should persist for several years to come. According to some estimates, uninvested dry powder in the private equity market stands at a record $1.3 trillion, and this capital currently remains undeployed in large part due to high valuations and in numerous markets currency volatility. Add to this the political, economic and governance challenges in many emerging and frontier FDI destinations, and picking a winner has rarely been more critical. Amid this bumpy ride, we are seeing focused activity by specific groups of large asset managers, in particular the pension fund community. These investors, increasingly active in emerging market direct investment over the past decade, are starting to blaze a trail in the standards they are applying for M&A due diligence and the risk management expectations of their portfolio companies. This is doubtless connected to the very long tenor of their preferred investments and their fiduciary duty to provide solid returns to arguably the most diverse group of ultimate stakeholders. These are large private investments with the public's money. We are consistently impressed with the energy and diligence of the deal teams that we work with in their pursuit of the ground truth around significant potential value detractors during the acquisition process, whether these be intractable regulatory challenges, poor social engagement practices that feed long-term risks, or pervasive corruption issues. These companies realize that simply carrying out a check-the-box approach to due diligence creates blind spots that obscure off-balance sheet risks. They also recognize that the risk governance capabilities of the target company are key to its prospects for value creation while part of their portfolio. There's a lot of debate around the relative merits of environmental, social and governance programs, or ESG programs. At Control Risks, we believe that ESG has significant potential beyond the ethical and the reputational, and can be used as an excellent long-term framework to support value creation by mitigating significant long-term, even existential risks. Alongside carrying out good country risk analysis, striking quickly when opportunities present, and rating the risk governance abilities of intended targets, these collective risk mitigation strategies can provide greater assurance when the wider investment community dives back into emerging market M&A.